How we manage and record investments, property, stocks, bonds, finances, and anything with cash or anything business operations related is extremely important. Statement of cash flows is what we are going to focus in on today. It's been an honor and privilege to work with my team, Jennifer Ortiz, Alistair Churchward, Michaela McAlphin, Tiffany Pace, Helena Amnon, and Nakib Khan, and I am Robert Campbell. After much research and study, we will explain and tell why we think GAAP or IFRS is better concerning different aspects of the statement of cash flows. There are pros and cons for the method of accounting under GAAP and IFRS, respectively, and namely, today dealing with the statement of cash flows. We will show comparisons between GAAP and IFRS with intellectual reasoning behind one way, GAAP or IFRS, why it is better or worse than the other. However, there are costs and benefits to both methods, as you will see. So first and foremost, what is a statement of cash flows? The statement of cash flows is a central component of a company's financial statements and provides key information about its financial health and capacity to generate cash flows. Statement of cash flows is essential because it provides vital information about an entity. It shows the movement of money in and out of a company. It helps investors and stockholders understand how much money a company is making and spending. So as I said, my team's here today. We'll go and get started on being more in depth dealing with the statement of cash flows, GAAP versus IFRS. What components are in the statement of cash flows? There's three components within the statement of cash flows to choose from. One, operating activities, which is to connect the income statement and the balance sheet. Any cash that affects the income statements will go to operating cash flow categories. Two, investing activities, connected to the asset part of the balance sheet. There are sales or purchases of assets. Any cash used, sell or purchase or invest into assets is in the investing activities. Three, financing activities, connected to the liabilities and equity part of the balance sheet. Companies can issue stocks to the market for exchange for cash. That's what happens within the financing activities part. So those are the three different categories and activities that we can classify within inside of the statement of cash flows. So as we talked about, so GAAP versus IFRS. GAAP is, as you can see, generally accepted accounting principles. IFRS is the International Financial Reporting Standards. So GAAP is a common set of accepted accounting principles, standards, or procedures that companies and their accountants must follow when they compile their financial statements. IFRS is a set of international accounting standards which state how particular types of transactions and other events should be reported in financial statements. Some accountants consider methodology to be the primary difference between the two systems. GAAP is rules-based and IFRS is more principle-based. 3, 2,
For the most part, US GAAP and IFRS are already very similar, so the basic accounting fundamentals are the same. No matter where you are around the world, you have the same set of financial statements, the same basic accounting process. There is just certain circumstances that are significant difference. And probably the most differences between US GAAP and IFRS is that GAAP is rule-based, whereas IFRS is principle-based. In fact, US GAAP actually writes out all the different rules that US companies have to follow. IFRS is a little different. IFRS focuses on the overall principles, which allow for much more interpretation. On the practical level, this means that US GAAP is much longer and more detailed than IFRS. The next thing that I want to talk is about the format of a statement. This is really important for cash flow statement. It can be either using the direct or indirect method. The direct method is encouraged for IFRS. The US GAAP, similarly, You can use direct or indirect method, but again, the direct method is encouraged.
Hi, today I will be talking to you guys about interest received and the difference between GAAP and IFRS. So what is interest received? Interest received is an amount received for the use of money that is to be repaid in full or at a specified time or on demand. Under GAAP, standards it prescribes that interest paid and interest received should be classified as operating activities, while international standards are a bit more flexible. Under IFRS, a firm can choose its own policy for classifying interest based on what it considers to be appropriate. Under IFRS, interest received is placed under operating or investing activities. Now we'll move on to interest paid. So what is interest paid? Interest paid means that as of the last day of any fiscal period, the sum of all interest, fees, charges, and related expenses paid for that fiscal period to a lender in connection with borrowed money or the deferred purchase price of assets that is to be treated as interest in accordance with GAAP or IFRS, depending on your financial reporting. For interest paid under IFRS, it can be placed in either the operating or financing sections of the cash flow statements, while GAAP places their interest received and interest paid under operating activities. As you can see, IFRS are less restrictive. Both interest received and interest paid can be classified as operating or investing activities. US GAAP allows them to classify them as operating activities only. GAAP includes similar principles, but when a transaction has characteristics of more than one class of cash flows, and each separately identifiable source or use of cash cannot be reasonably separated, then a company applies the predominance principle to determine the appropriate classification for the related cash flows. We find the main determinants of operating cash flow enhancement classification choices are capital market incentives and other firm characteristics, including greater likelihood of financial distress, higher leverage, and accessing equity markets more frequently. In analyzing the consequences of reporting flexibility, we find some evidence that the market's assessment of the persistence of operating cash flows and accrual varies with the firm's classification choices, and the results of certain OCF prediction models are sensitive to classification choices.
Dividends is the distribution of corporation profits to eligible shareholders. It can be seen as a reward for investors for putting their money into the company. GAAP is a rule-based system. Companies must adhere to the rules when complying their financial statements. This helps them from falling prey to manipulating their books. On the other hand, IFRS is not rule-based. IFRS states that a company's financial statements must be reliable, understandable, and relevant to the financial transactions. So with dividends received, under GAAP, companies must put it underneath the operating activities, while under IFRS, dividends received can go underneath either operating or investing activities. Moving on to dividends paid, under GAAP, companies must put it underneath the financing activities, while under IFRS, a company can put it underneath either operating or financing. In conclusion, when looking at both GAAP and IFRS has more freedom in how a company wants to record their dividends paid and received, while GAAP, they must adhere to the requirements that have set in place.
Taxes paid in GAAP and IFRS, how they differ in the cash flow statement. So to get us started, taxes paid means a contribution for the support of a government required of persons, groups, or businesses within the domain of that government. Taxes paid are a fee or due levied on the members of an organization to meet its expenses. In GAAP, cash flows relates to income taxes that are generally classified as operating activity only. In IFRS, income taxes are generally classified as operating activities unless they can be specifically identified with financing or investing activities. So there's more flexibility in IFRS in comparison to GAAP in the classifications. The reason as to why GAAP may have taxes paid only be under operating activity may be for simplification and convenience purposes. By making operating activity the only classification for taxes, GAAP may be preferring that accountants do not focus their efforts too much on trying to make 100% accurate account because of how tedious and time-consuming this process may be. Instead, GAAP encourages accountants to record all taxes paid on a single line item. IFRS, on the other hand, allows accountants more flexibility with taxes, thus making implications of thoroughness and complexity. Because of this, they allow investors to know more about their businesses and to make informed decisions.
Okay, so what about these differences in the real world? We have three areas of importance to highlight: operating cash flow relevance and reliability, cash flow comparability, and GAAP IFRS convergence. Cash flow, and particularly operating cash flow, is well established as a basis for business valuation, contracting, and financial analysis. US GAAP requires that firms classify interest paid, interest received, and dividends received as operating cash flows. In contrast, IFRS allows firms the flexibility to report these items as operating cash flows or as investing or financing. The effect of flexibility in cash flow classification and its consequences matter because both the International Accounting Standards Board, IASB, and Financial Accounting Standards Board, FASB, share the objective that financial information should enable financial statement users to better predict future cash flows. Furthermore, both boards articulate the importance of accrual and cash flow information in achieving this objective. In a formal study, Flexibility in Cash Flow Classification under IFRS, Determinants and Consequences by Gordon et al., they looked at a sample of 798 non-financial IFRS firms in 13 European countries from 2005 to 2012. The results indicated that the firms with a higher likelihood of financial distress, as well as those that issue more equity, have higher leverage, and are less profitable, are more likely to make operating cash flow increasing classification choices. They are less likely to change when they are followed by analysts, have more peers making similar choices, and are cross-listed in the US. In short, companies that are struggling will do things like move interest received from investing into operating to enhance their operating cash flow position when the reality is very different. This directly goes against the relevance principle, as you are masking predictive information as well as not being neutral in your presentation of financial information. So this operating cash flow manipulation, it leads into another issue tied to the nature of the financial information being presented and the accounting principles tied to it. Whereas operating cash flow manipulation affected the relevance and reliability of financial information, the same IFRS flexibility also presents problems with comparability. So comparability is the level of standardization of accounting information that allows the financial statements of multiple organizations to be compared to each other, and seems to be where IFRS flexibility in classification struggles. The July 2019 ISB staff paper, Financial Statements, Classification of Interest and Dividends in the Statement of Cash Flows, discusses the challenges of allowing different interest and dividend classifications in the Statement of Cash Flows while proposing to put interest dividends paid into financing and interest dividends received into investing. This would streamline the comparability between firms and was tentatively accepted. The need for the streamlining can be seen in the table. So this table that we have here of 85 non-financial entities shows how varied the classification can be when allowed alternative classification types. Outside of dividends paid, there are substantial differences in how companies are reporting interest and dividends in their statement of cash flows. So you can see interest paid, 51 in operating, 31 in financing, interest received, 47 in operating, 29 in investing, dividends received, 32 in operating, 38 in investing. So this variation within non-financial firms is more work for preparers and users to understand the financial information they're being presented with. Again, how financial statements from different organizations can be compared to each other is problematic with the IFRS flexibility. So this last point about extra work in financial statement preparation and use or comprehension by the user, it's brought up in the staff paper as an alternative approach that was proposed to not only address the comparability issue, but also convergence with GAAP. The proposal sought to classify interest paid, interest received, and dividends received as operating. This matches well with GAAP and would seem to be something worth pursuing, as GAAP and IFRS have both committed to convergence in their accounting standards. The concept of convergence between GAAP and IFRS in a lot of ways is bound up in the idea of comparability between the two, and it is telling that the IASB staff recommendation, instead of adopting this alternative proposal, is to be wary of unintended consequences and make incremental changes going forward. Thus, it would seem that comparability instead of convergence may be the path forward, which would at least acknowledge the international business weight of GAAP in setting accounting standards while allowing IFRS to remain flexible and subjective as it maintains a global scope. So there you have it. In specific cases, the flexibility of IFRS can reduce relevance and reliability, make comparability harder, and causes issues with convergence with GAAP, leading some to think that comparability in increments may make more sense.